you everyone for joining. I think there is a lot of people going to join us later, but I think we will start as we have a big agenda. So just as to give an overview, we'll talk about especially structured products in Canada, as well a bit of estimates what I think the market and these products have been performing in Canada as well as around the world. So I also had the pleasure to have here with me Martin Pelletier. A lot of you know. He'll introduce himself later on, okay? And he has a couple of slides on his view of structured products and financial markets and how you can actually use them. Not theoretical, but actually with a lot of practice. From our side, we are going to focus on the trends and innovation in structured products, talking about how structured products in Canada have been performing year to date. So let's start. Look, of course, we need to discuss is the economic landscape, right? And a few things here we need to discuss. Of course, is the equity market performance. Most of the underlyings of structured products are equity markets, and on this, although I could do and use the Canadian underlyings, I decided to show you more the US equity markets, as they are the biggest drivers of equity markets performance globally. What you see here is, do you see the Russell performance, the Nasdaq and S&P 500? Year to date, massive increase of technology. As you can see by the Nasdaq, a lot of it has to do with the AI, but as well as the top seven stocks. And we talk about it and what was the impact of those within structured products. S&P 500, you can see it's up. It had a good year. You had a couple of scares, especially with the Fed decision of hiking, not hiking. Now we're talking about probably decreasing rates next year. And of course, the Russell, the small cap indices has been slightly positive, but clearly an underperformance this year. And this is the more interesting, right? We've talked about how volatility has been a big factor this year. A lot of volatility with all the different things that is happening around the world, right? In Israel, in Ukraine, and many other events in China, etc. But if you look at the equity markets volatility, it's less than 60% of what it was at the beginning of the year. I mean, a massive drop. And that also has been impacting structured products, especially on the income side. But we'll talk about them in a couple of slides. Then I'm going to talk about a few global trends, okay, that we've seen, especially this year. A couple of here. The first is uncorrelated worst-off baskets. I mean, when interest rates were lower, and you probably remember from all the Canadian banks structured products being offered, there was a lot of worst-offs of using equity indices worst-offs. What we've seen recently, it's because correlation is slowly decreasing, we see less, and interest rates are high, we see less worst-offs, so less number of indices or stocks. But actually, this one was quite interesting, was using very correlated indices. The particular case was in the US, where Bank of America issued worst-off autocallables between the S&P 500 and the S&P 500 equal weight. And why I mentioned, because they were able to offer, again, in US dollars, just 10% monthly coupons. That 10% is annualized, of course. But when we look at just the large cap worst-offs between 1, 2, and 3, you can see there was a big pickup on yield, going from 9 to 9.75 instead of just 10% with free underlyings. So interesting way to get a bit more yield, but slightly less risk. Of course, the big thing here is you're betting that tech will not go down, as you know they've been the biggest driver of S&P 500 performance. Then the second thing, which is very interesting, and I think we've seen a few in Canada, and I think they will increase next year, is autocalls, capital protected autocalls. I mean, and I know Martin is very keen on these yield products, and he will definitely talk about it. I think what we've seen, you know, it's 4 or 5 years GICs or you know deposits, worst off between 3 indices, offering annualized yields of 6%. Quarterly autocalls after 1 year. I think that's quite interesting if you compare with the GICs offering now 3-4%. But again, here you get an extra 2% yield, but with no capital at risk for the 4 or 5 years if you hold the product, which I think it's a quite interesting product for, let's say, more risk-averse clients, and the way to get them into more equity type from the fixed rate GICs. Then the other big topic, and this will be the last one before going to focus on Canada, is income. I mean, income, especially with high interest rates, higher inflation, is that there is massive demand for callable yields, autocallables as well, issuer callables. And we see a massive growth, and you can see there total sales in Canada, especially on income products. You can see it's growing, especially due to fixed income products. So more interest rate related products with a bit of optionality. You can see there is a massive growth, and that number is from end of October. So it's definitely growing even faster this year. But what you see is that on the right, you have the average coupon offered. So, on the right chart, on the right axis, you can see that the average, let's say, headline rate is above 11%. And the average coupon barrier is now at 68%, just below 68%. So what we see is that a lot of the yield autocallable products, which again, I think Martin will give us a lot of practice examples, they are looking into offer good, you know, repetitive coupons, even though the autocall, the autocall by the issuer or the callable by the issuer is later in the life of the product. Clearly the way to get the yield to fight inflation. And it's, you know, it's getting a lot of interest from investors. Now, let's talk about average performance of the Canadian market. I think, Martin, I think you saw this yesterday when I shared my slides with you. What I can tell you is that structured products in Canada year to date, performance has been amazing. More than 8% analyzed yield year to date on all issuers. Okay, and that includes GICs, principal protected notes, and principal at risk notes. If I look at the principal at risk notes, which again, it's the biggest part of the market, is offering average realized return above 9% per annum, which are definitely very, 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 very interesting for the Canadian market. And you can see here, right? A new 3-year new GIC rate is around 4%, and these autocallables are offering 9%. So 5% premium on these products, right, with a protection of 40 or 60%. That on the space of 4 or 5 years, definitely very, very interesting. Again, we'll see how it performs, but the coupons are still being paid, even if the market has been not performing that well this year. And on the right, we tell you the average performance per underlying, the most successful underlyings. But you see that there are 2 selective indices, pipeline index, as well as an insurance index, has been the best performing this year, followed by some stocks, no, the XBI UP, the Shop UN equity, and you can also see the Euro Stocks banks, having more than 11% yield. And we'll talk about it. And to be honest, you'll have a Q&A at the end, so everyone can then actually you can start asking questions. But is one of the topics that I will want to speak with Martin at the end is to talk about the bank indices and how do we see that performing next year. Now, in terms of the Canadian market, what you'll see is that it started performing very well. Q1 very strong, more than almost 13 billion Canadian dollars sold. Q2 was the best, and then it's been slowing down. Q4 is still missing December, as we're only halfway of the month. But it should be the worst quarter of the month with probably around 10 billion Canadian dollars. Then this is our estimate. Again, this is, you can see also the outstanding is what we'll see is that, the on equity structured notes and equity GICs, we see that more than 110 billion Canadian dollars outstanding. So actually, the total exposure structured notes and the equity GICs have been increasing, especially compared with last year, which was just below 80 billion Canadian dollars. And on top of that, you have more the interest rate products, which will almost double the size of the Canadian market. Now, I'll talk a bit about investor perspective and sentiments. There will be a mix. I'll give the word to Martin, and then we'll talk about what we believe for next year. What you see, especially in the US, is that there is a slightly positive sentiment, and even P ratios are actually their average of the last 20 years. Although a lot of people are talking that market might be too high, when we look at the numbers as the sentiment as well as the price earning ratios, it's still at their average of the last 20 years. So we're actually not that negative for next year. Another thing which I mentioned, and again I'm going to repeat, is capital protected products, especially GICs, massive growth, as you can see there, but it's slowly decreasing as interest rates start also to change, especially the yield curve, the long-term rates. What you see is that income products, principal at risk notes are getting a lot of demand, especially this quarter and the previous one. So you can see Q3 sold at more than 4 billion Canadian dollars. I think this quarter will end up also above 4 billion Canadian dollars. So even though market will slow down, we can see that income products are still increasing. Again, for the people who don't know about the Canadian market, equity indices, of course, are the most popular. What's interesting compared with Canada and other markets is the big weight of Canadian banks index. You can see Selective Canadian Banks 40 index, which is the biggest, the most used underlying, 18%. And if I look to all the different indices and stocks, almost 1/3, 28% are structured products this year has been sold. Has exposure to financials, followed by the large cap like the S&P 500, US, European exposure as well, Canadian with the TSX, and then we start to have, of course, all the single stocks products that offer higher yield. But you can see here a lot of exposure to banking sector. And on this, I'm going to give the word to Martin, who will go through our slides here. And Martin, I'm pretty sure a lot of the people attending already know you, but nonetheless, probably I'll let you just say a few words.
Sounds good. Thanks, Diego. I don't think I can start my video. Can you see me?
No, we can't.
Okay, it's saying you cannot start your video because the host has stopped it.
Okay, let me 1 second. Let me try. Oh, unfortunately, I don't think I can.
That's
I can
okay.
try to stop share the screen, but I think you don't have the presentation.
No,
So yeah, maybe apologies, but we'll probably
that's
have to do
fine.
it on video.
I'm wearing a suit jacket and a tie. You can trust me on that one. So thank you, Diego. Hello, everyone. So I'm a portfolio manager. I run a balanced fund and I run accounts on a segregated basis for high net worth individuals here in Canada. And we've been running, introducing structured notes into our portfolios for the last 3 years, and it's had a meaningful contribution to our overall performance. Our main goal is to target for a conservative client a 5 to 7% return and minimize the risk as much as possible to do that. Now, I have an experience with my partner of trading options for about 10 years. So we're quite familiar with structuring option strategies around indices. And the nice thing about structured products, although the tax efficiency has been lost, but the nice thing is it's all wrapped up into one nice tidy note and nice and clean to track and to own and purchase and to run into your portfolio. And the way we own structured notes, the way we view them is on this chart. We don't use it as a growth or equity replacement. There's been all kinds of negative press about how equities have outperformed structured notes. Well, yeah, I mean, if you go long equities over the longer term, the probabilities of a decent return, obviously which market you're going into plays a role in there. But having said that, equities will no doubt outperform a structured product. So it's a completely different type of vehicle for your portfolio. And the way we view it is as a fixed income replacement into our portfolios, as a mix between government corporates and maybe on the front end a very low risk, high dividend yielding equity. And so we're running that within our portfolios, and that's been very beneficial, as you know, with bonds selling off the last 3 years here. Could we go next slide? So, why do we have them? I've written about it in the Financial Post. You can email Tiago for copies, or you can just Google structured notes in my name and you'll find it. It does have lower volatility to equities than some bonds. Nice thing is you can custom build the downside protection from 25 to 100%. Interestingly enough, on Tiago's chart showing the preference for different types of products, but capital protected products, it's been decreasing as markets have been going higher. And that's not unexpected because people get more confidence when markets are going higher. And that's the time you probably should be looking at doing some of the larger downside barriers when markets are testing some of their highs compared to when they're testing your lows. And so the risk definitely influences the types of notes that are being purchased. You can get some really attractive coupons that can be paid monthly or yearly. Yields can range significantly depending on the type of note that you're doing. And you can custom build across markets, segments, or sectors. And so this is a really good value add that you can do for your clients, is you can build a portfolio of notes and diversify that portfolio for your clients. So you've got the exclusivity of the notes, and then you've got the ability to custom build them for their clients. And the nice thing is you create what we call asymmetric return or risk profile. So you're getting more return and less risk. And so with our goals-based target of 5 to 7, all we have to do is try and get that 5 to 7% and minimize the risk. And we find that for conservative investors, if you get returns in that range and minimize the drawdowns, you have a client for life. And so, the other benefit is, you've got some liquidity, better liquidity. You can sell them back to the issuer, and better than some of the other alternative assets. that are not priced appropriately, and you can't sell them. And so, you know, they can generate a decent return in a flat to down market. And you can even use it as a GIC fixed income replacement. And so when you're looking at bonds versus equities, a lot of people are going to be moving into equities. So the structured notes are probably going to go down from the growth perspective. But from the income perspective, you know, we haven't seen a big move into bonds, maybe the last 2 months or so here. But the Fed rate is 5.25, and the 10-year Treasury is at 4.25. So the market's pricing in some very large interest rate cuts next year. And that isn't to say that's not going to happen in the US, but if it doesn't, you could actually lose money again on bonds next year. And so to get a 4% return, that's not going to meet your clients' objectives, and you're exposing your clients to some risk on betting on interest rate direction in the US. Next slide. So what I did was I went back and I took a look over the last 5 years, and if we did an all bond portfolio, if you did a 60-40 portfolio, if you did a 50-40-10, and an all stock. Now a 60, just to explain, 60% stocks, 40% bonds, 50% stocks, 40% bonds, and 10% cash, and then all stock. And looking at equities being, you know, the MSCI global equity. So that would be 60% US, which has been highly outperforming other markets. And so you can see bonds have done nothing over 5 years, but they've exhibited a 6% standard deviation per year. So, you know, quite a bit of variation for no return. The 60-40 portfolio has done, you know, 6% over the last, this is to the end of November, so it's accounting for the large gains in November. It was a lot worse than that prior to November, but 6% and 12% variation in the portfolio. So, you know, that would meet our 5 to 7% goals. But let's say we were overweight Canadian equities, and we probably would not have met that, maybe at the lower end. Now, equities obviously did a lot better, primarily because of the US, but you're also getting a lot more variability in your returns. And so, you know, comparing a structured note to an equity just doesn't make sense from our standpoint. But if you look at what we call our 50-40-10, so 50% long, 40% structured notes, 10% cash and fixed income, so it'll be a blend of the two. Mostly US floating rate bonds is what we've been doing. You would have got a 2% boost to the 60-40 in returns. So a 2% annual return greater than the 60-40. But more interestingly enough, the variability dropped by 2%. So you've got more return and less variability in your portfolio. And that's the value that you could add to your clients, is when they look at the portfolios, they're not seeing the ups and downs as nearly as much as a 60-40. Or even those who have a 50-50 or a higher bond weighting, there's been a lot more variability in that portfolio. And so you can see that this is from the Structured Note Solutions Group at National Bank. They're going to update it at the end of this year. But you can see that of all the notes that they've issued over from 2016 to 2022, 97% have generated positive returns. And then only 2.1% have returned capital, and 1.3% have generated negative returns. And so, you know, an average realized return of 7.7%, and the highest quartile being 12.8, and the bottom quartile being 3.5. And so this also goes to show that you can add some value to your clients by managing the portfolio of structured notes, because look at that range, 3.5 to 12.8. And so, again, you can go in and take a look at, is it a good time to buy principal protected? Is it a good time to do an auto call or contingent income? And you can custom build it according to what the client's trying to achieve. Next slide.
Yeah.
So I'm not just, you know, throwing theoretical numbers out there. And, you know, as you can know, back tests are back tests. You can choose whatever indices you want to make the numbers work. So I'm trying to be fair here. And so this is our balanced growth fund. And we're running about 35% on average, up to 40% in structured notes and within the fund. And so as you can see, this year we're underperforming. We're only up 6.2%, and our benchmark is a passive portfolio would be a passive 60-40, and the disclosures below us what that index is 8.4. But and then on 1 year basis, we're underperforming as well too. But our main goal is over a longer period of time is to get that 5 to 7% return and minimize the risk. And we've done that over the last 3 years. We generated 6% a year versus our peers at 1.5%. And 5 years, we're at 7%, the higher end, versus our peers at 4.2%. And so overall, we're achieving those kinds of outperformance. And so we try not to benchmark ourselves to any sort of passive index, because clients will say, well, why didn't I get 8% this year versus 6%? We're just, hey, look, we have to get you 5 to 7, minimize the risk. And we did that. And if you did that, if you went somewhere else and you did that, or you did it on your own, you're high likelihood you wouldn't have met your financial goals and objectives. Next slide. Now, what we did was I carved out the notes that we own within the fund itself. So we can show you how we're managing the sub-portfolio of structured notes within that fund itself. So we have 40 individual notes. Now we have, because I told you, we're focusing on income. So we have 70% income focused because we're using it as a fixed income replacement. 27% growth and 3% income and growth. Our average term to maturity is about 5.3 years. Now, the thing is about these things is that, as you know, they will trade below par. And so your clients have to be made aware of that. And it's no different than if you owned a GIC. The difference being is that it's being priced in the market all the way to the term, all the way to the maturity date. Okay. And so your GIC will likely be trading, below that value along the way. You just don't see it, but you do see it in this case. But having said that, we're still running about a third of our portfolio above par, which goes to show the value of portfolio management that we're adding for our clients. 64% are well above our downside barriers, so we can show our clients how much room do they have if market's correct, and only 2% are below our downside barriers. And you do have, it's a portfolio, so sometimes you do have those that have underperformed. And so when we looked at the returns, returns are very similar to what Tiago had said. Our notes are up about 9% in this year. And our total return over the last 3 years, when we started adding them into the portfolio, into our note fund, was about 15.2% total return. And that's under our fund's total 19% return, but well ahead of the balanced total return of 4.5% over 3 years. And so, as you can see, it's really been very beneficial to our portfolios. And from a portfolio standpoint, we have a big chunk into the contingent monthlies, and we do like the geared buffers. The reason why we like the geared buffers is it minimizes that variability in the underlying, so it provides clients more comfort in seeing less of that ups and downs. But we have to sacrifice some of the returns. But overall, if we can get 5 to 7 on our note portfolio, knowing that our equities over the longer term are going to achieve the same, maybe higher than that, complemented by a 10 to 15% weighting in cash and front-ended bonds, which fortunately are paying 5 to 6%. We're going to be able to meet our goals and objectives. Next slide.
Thank you. Perfect. Thank you, Martin. We'll come back to you because I want us to have conversation on a couple of topics. Look, as mentioned, and as Martin mentioned, and me, I mean, the autocallable, the yield notes, especially autocallables, which can be called depending on how the underlying perform, are actually a big impact of the whole industry because they are very attractive, as Martin said, and something we'll measure is total volume expiring early and maturing throughout the different months. And what we've seen, especially as some of the underlyings have been underperforming, especially between June and September, we saw that number of products expiring early decreased quite substantially. So that percentage is total outstanding structured products expiring on that specific month. But what we've seen is that from October to November, as markets started to improve, we see that an increase on the callabilities, which gives an indication on how the market will perform in the next months, in the next year. And the other chart, which I think I've shown you before, it's the monthly average annualized return of structured notes and GICs. And you can see, as markets decreased, you could see that the performance also decreased, especially with some of the notes underperforming, as Martin said. But then recently, from October to November, we saw a tick again on the performance, and we expect December to be another a very good month for especially capital at risk notes in Canada. On that, let's talk about 2024. Look, I think there are some headwinds for structured product sales, especially how structured products are currently at versus their initial strike level. And what you see is our estimate for end of the year, which should have been selling around 44-45 billion Canadian dollars. This is our SPI estimate for the whole year. Of course, that number might vary. And then there you have our estimate. Okay. Now, what we see is that most notes are slightly below their initial level. So they might not called unless underlyings go up at least up to 10%. So what we estimate is that structured products in Canada might just have slightly below number, 43 billion from 45 billion next year. But the one thing is that if the underlying goes up, the market might again have a new record year, especially with 60 billion Canadian dollars. And this will be all new records. And our estimate is that that number will be achieved. The S&P TSX 60 gets to 1,300 level. And you can see that the split between maturities, products getting to their maturity, providing the capital back. You can see there the coupons. Most of the coupons on structured notes are usually reinvested. So we see that. And we also have new money. I think the one thing that we see is we still see a lot of Canadian investors getting more interested on, especially on the yield products, but also on the growth. And of course, the big dependency will be on the early redemptions, the auto calls expiring early, as you can see there. Now, taking that into account, I'd like to open to Q&A, both for me and Martin. So please feel free. Let me just check if Q&A is open. Yes, Q&A is open. But while we wait for others, Martin, I wanted to discuss these 4 topics. And I think the first one is the Canadian banking sector. I mean, it's one of the biggest underlyings, Martin, one of the most popular that banks have been using on structured notes. What's your view in terms of using Canadian banking as an underlying?
Well, you want to make sure you've got a basket, first of all, because as we saw in the last quarter, quarterly reporting, some did much better than others. And so unless you're an analyst, being able to pick which ones you like, owning a basket is probably the best approach. And fortunately, that's what a lot of the products are being offered. And now, having said that, I think the Canadian banking sector is probably flat this year or in 2024. There's a lot of headwinds, especially as there's in the next couple of years, $900 billion of mortgages coming due for renewal in a higher interest rate environment. I think the Bank of Canada is going to be cutting rates sooner than the Fed does, and I think they'll be cutting as early as the end of Q1,
Mhm.
and so that's going to be beneficial to providing some relief, and so I don't see a lot of downside risk because inflation numbers are coming in significantly improved, and the economy is slowing down a little bit enough so that it'll get the Bank of Canada to cut rates, provide some interest relief, and offset some of the risks on the banking side. So, and if you're in a flat to dead money scenario, then you can look at type of the option writing that you would do around that. And so like on the option side, we would, be doing cover calls, owning them, getting the nice dividend and cover calling them. Or you can look at some of the auto callables on there that have a reasonable, a target that you can achieve to generate a nice rate of return. So I'm not bullish. I'm more neutral on the Canadian banking sector, and I'm more neutral as to our positioning within that as structured notes.
So look, something that, of course, it's connected with the Canadian banking sector, right? Is the yield curve, it's the interest rates environment,
Yeah.
right? Fed increasing, not decreasing. I mean, I guess the Canadian central bank will definitely look at it. How do you see it? Because it will also impact Canadian banks, but as well all the new structured products, right? Because for people who are less familiar, right, with structured products, most of the yield is obtained when interest rates are higher, and of course then the volatility. So, what do you say? What are you looking at your portfolio when you're thinking about new products to invest next year when it comes to interest rates?
Well, I want to look at some of the sectors that have been really beaten up because of those interest rates. And so instead of a contingent income, I may do an auto call on utilities or pipes, for example, that have been beaten up. And so the yield being offered because of the excess volatility in that segment is going to be better. And so as interest rates fall, those underlying indices will do better themselves. And so the pricing is pretty attractive today, or the last couple of months, with those sectors selling off because of fears of sustained higher rates. And so I consider it a lower risk way of playing a rate drop and the impact on those segments of the Canadian market. And so obviously I think you'd be better off just owning the underlying index, but for a conservative investor, where we add a little bit of the growth torque side of our portfolio, the pricing is good. You can get up to, we just did one with a blend of some of the banks with some of the pipes, some of the utilities, that if it's above 0 in 12 months, it closes out and I get a 26% coupon. And so that would be the growth component. It's a smaller component of our overall structured note portfolio, but that's again where the value of a portfolio manager can come in and say, okay, you're not just looking at the absolute yield, you're looking at the underlying segments and what's it going to take to get that yield and where the risks involved.
Okay. Thank you, Martin. Look at the topic, right? For example, I'll give my view on volatility, right? Volatility is been quite low, and and within the traditional market, I can see a lot of hedge funds buying volatility, and something for people to be aware because of structured products and the popularity, especially on autocallables. I actually have a view that volatility might go further down, which will lower the coupons on the autocallables, and a lot of people are now looking at how they can hedge that risk, especially against hedge funds. So, Martin, particularly in Canada, how do you see volatility playing next year?
So if the current momentum in the market is, I agree with you, probably lower volatility than higher volatility. And it's just, that's the nature of where things are at. And when volatility is low, it's not a good time to be, you know, to be harvesting it per se. And what I mean by that is there's a great saying is picking up pennies in front of a steamroller. And if the yields aren't sufficient enough, and all of a sudden you get an unexpected volatility spike, then you know, that could really hurt you. And so what I mean by that is I probably would be adding taking advantage of that low cost of volatility and adding some put protection into the portfolios, because it's relatively a lot cheaper than it was. You said 60% down from the beginning of the year. So for example, if you're in the tech, you've got a nice exposure to the tech space and you've done fantastic this year, what you could do is, or the S&P, you could sell that position itself and move into an equal weight structured note, just to de-risk that portfolio. Or you could do sell your Mag 7 stocks and custom build, or do a note on structured notes with downside barriers on those techs. And so you're just de-risking it and locking in some of those nice gains. So if tech continues to move higher next year, and I'm looking at the multiples, and from a multiple standpoint, I think it's quite expensive. But if they move higher and you get the call wrong, you're still going to make, you know, 9 to 10%, not 30. But you know, I see that being a low probability event. And if they tank, you've locked in some nice profits and you've got some downside barriers. So that's where structured notes can be an offset to your equity exposure and looking at the volatility underlying it.
Thank you, Martin. Like, I don't want this because you know to run over, and I think we're already on 45 minutes when expected, just half an hour. If there are no more questions, I think there isn't. Look, Martin, first of all, thank you for participating in doing the webinar with me. Much appreciated. We'll send the slides to everyone who participated. I can see we had a very good turnover. So if you have any questions, feel free to come up with me. I'm sure Martin will be available to answer, and I will send the slides. He has the link that Martin mentioned to his structured products article. So yeah, thank you, and thank you, Martin.